This is your money mom. Let's talk refinancing your mortgage. So, I'm Nancy Piccioni, a freelance writer and a money coach, and I help people get better with their money. My website is yourmoneymom.com. So, in yesterday's video, I talked over some of the reasons you should consider for and against refinancing your mortgage with today's very low interest rates. And today, what I'd like to do is very briefly go through a number of scenarios with a hypothetical family to talk over some of the reasons why you might consider refinancing your mortgage. So what we're going to do is just go to Google and put in mortgage calculator. And when we do that, you're going to get a lot of different results from banks and other places, but we're just going to use the very simple mortgage calculator that Google serves up. And so what we're going to assume is a family that has $100,000 remaining on their mortgage, assuming their house is worth, say, $200,000 or more, so that there's plenty of equity in the house, and they have 20 years remaining, and their original interest rate was 6.5%, and they have not 6.5%, and they have not refinanced. So their mortgage payment is $746 currently. Now, if in this case, their mortgage payment is probably higher because usually people fold in insurance and taxes into their mortgage payment. Those things are held in escrow by your bank and paid out over time. But we're only interested in the principal and interest, which are the things you can change about a mortgage. So the amount that they're paying towards principal and interest is $746. Okay, so now that's our scenario. Let's pretend that the family want to keep having 20 years left on their mortgage, but they're going to refinance with today's lower interest rates. And if we do 3.2%, the interest rate's a lot lower than that now, but let's just assume that with closing costs and things. So 3.2% for 20 years, you're going to shave almost $200 off your monthly payment that you are required to pay. So previously at $746, you've brought it down to $565. A pretty good deal. Definitely worthwhile for going through the trouble of refinancing, because it is quite a process. All right. A next scenario is let's say that they want to refinance with a 30-year loan because they want even more flexibility. Then you're going to be taking more than $300 off of the $746 payment. Pretty dramatic. Now, the benefit of refinancing with a 30-year loan would be to really give maximum flexibility so that the family still could pay the $746 and would pay it off much sooner, in about probably 15 years. We're going to go through that in a bit. But they have the flexibility to not pay that. You could always fall back to that $432 if there were a big bill or something else, some other expenses going on. So that can be very, very helpful and worthwhile. And to show you that, let me just pretend that the family wants to pay it off in 10 years rather than the 20 years. So if we move the loan to that, you can see the rate has gone up more than $200 from the current payment of $746. And locking yourself into that is not necessarily the best idea because, again, you want the flexibility. You could always pay about $1,000 every month if you can afford that, and you'd pay it off in about 10 years if refinancing at 3.2%. But that's what you would do. Even if considering, okay, the original payment the family is doing right now is $746, if you refinance even with a 15-year loan, you are going to come out ahead because you only have a $700 monthly payment. Now let's talk about the slightly more complicated cash out refinance. Now this would be for, I talk about that in the video. I'm not going to spend time here talking about the reasons why you might want to consider it. It's very specific, and you really have to run the numbers and have a plan for your money if you are going to do this. But we're just going to assume that a family is going to try to take out $30,000 out of their house. That, let's say it's worth more than $200,000. There's plenty of equity there. So now their mortgage amount is going to be a total of $130,000 at current interest rates. And we'll go with a 20-year loan. Their interest rate, their monthly payment would actually go down by about $10. Instead of $746, it's going to be $134. And if you bring that to $30, 30 years rather, it's going to bring down that monthly mortgage payment by about $200, as well as giving the family a large chunk of money to use for home improvements or other things that we talked about. I hope this is helpful. Just running through the numbers, you can definitely put in your own amounts here and see if refinancing would make sense for you. And then before you start the process, you can run the numbers and see how well it would work for you. I hope this is helpful. Thanks for watching.